How's everybody doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I want to talk about basically what's called the Conference of State Banking Supervisors, the CSBS. They put out an annual survey every year of community banks, and so I wanted to take a look at that survey to basically see, how are they feeling about banks in the banking industry right now, and what are their kind of top concerns? What are their takeaways? So I'm going to bring in two things. We're going to look at a PCBB blog post titled CSBS Survey Highlights Top Risks and Challenges. And then we're actually going to take a look at the 2024 CSBS Annual Survey of Community Banks, the report itself. But let's go in here. So first of all, a lot of people, if you're not familiar with banking, so every state in the United States has basically a state supervisory board. Like in PA, PA has the Department of, I think it's a PA Department of Banking and Securities. And a lot of banks have basically like the New Jersey State Department of Banking, that kind of thing. But every state has their local state supervisor. So if you have, say, a community bank that just has a charter in that particular state, they're going to have to report to the state supervisor. So typically, if you have a scenario, say you have a local community bank, I'll use Pennsylvania as a scenario. So say you've got a local community bank that's $2 billion in asset size. They are a chartered bank in the state of Pennsylvania, and let's say they have a holding company. So the holding company is going to be regulated by the Federal Reserve Bank. All holding companies are regulated by the Fed. So they're going to have to do some reporting to the Federal Reserve. Then if they're publicly traded, they're going to have to report some stuff to the SEC. But if they only operate in the state of Pennsylvania, most likely they're also going to have to report to that state's banking regulator. And then if they have FDIC insurance, then you have to submit to FDIC, and you're going to have FDIC exams. So you kind of have all these different regulators that you have to answer to for different things and different purposes. But if you are a nationally chartered bank, like if you're Bank of America or if you're JP Morgan Chase, the national regulators have to report to the OCC, and you would have to, you have to report to the OCC and the FDIC. So if you are reporting to the OCC, most likely you'll probably still have some interaction with the state banking regulator for your state, especially if you want to open up a branch, or if you're going to close a branch, or if you're going to open up a loan production office, or if you're going to open up an insurance division or a wealth management unit, that kind of thing. You're definitely going to have to go check in with the state regulators, the state banking regulators, and basically say, hey, we want to do this, we want to do that. And then you'll probably have to provide them with some information before they would say yes to anything that you're proposing to do. But basically, and I know that's very long-winded, but I'm just trying to give everybody an overview of how this works. So all of the state regulators, they all get together and they have this thing called the Conference of State Bank Supervisors, the CSBS. And basically they do an annual survey of community banks. They also do some other information. I should probably, check out their website sometime. It's got some good stuff on it. But anyway, so they basically looked at, they do a survey of community banks. The survey highlights the views of 367 respondent banks across 38 states, from banks with all the banks have less than 10 billion in total assets. So, and then we're going to look at external risks, and we're going to look at internal risks, and then we're going to see looking ahead. And let's see what this says. So respondents to the survey see regulation and cost of funds, i.e. the amount of money that banks pay out on deposits, as the joint top external risks facing their institutions. Increased federal regulatory and supervisory activity and the cost of compliance have likely contributed to the consistent increase in the percentage of community bankers listing regulation as an extremely important or very important issue. 89% in 2024 compared to 81% in 2023 and 77% in 2022. And I've talked about this extensively. Like, yes, there is a lot of regulation that is really kind of, gotten out of control in certain respects. So, like I said, like I reported on in the live stream and on other episodes, Jamie Dimon just came out and publicly and basically just said, yeah, certain aspects of the regulatory regimes are just kind of out of control, and we really need to rein those things in because they're really starting to hurt banks, and some of the things that they want to do and want to implement are really going to hurt banks in the next couple of years if some of those things are allowed to go through. So, it's not shocking that that's the big thing that banks see, and banks are paying out a tremendous amount of money on their cost of funds right now, which is really hurting profit margins. Like I said, you're seeing a continued kind of compression, if you will, of banks' margins, margin compression. So given the high interest rate environment, community banks are also concerned about net interest margins and core deposit growth. Although the Fed cut the interest rate in September, the expected decline in deposit costs is likely to lag. What's more, respondents see competition and economic uncertainty as the two most significant challenges to attracting and retaining core deposits. Yes, 100%. In terms of inflation, 43% expected to return to the Fed's 2% target rate in 2025, while 37% think this is only going to happen in 2026 or later. Encouragingly, just under 3/4 of survey respondents say that regardless of whether inflation persists or is more temporary in nature, it will be manageable. And then we get to internal risks. So with community banks increasingly adopting new technologies and engaging in third-party partnerships, it's unsurprising that cybersecurity continues to rank as a top internal risk. Almost all of the survey respondents, 96%, rate it as very or extremely important. Cybersecurity is also regarded as the most difficult challenge to manage in relation to implementing new technologies over the next 5 years. Technology implementation costs are the second most highly rated internal challenge and the biggest impediment to adopting new technologies. However, despite the costs, banking technology is seen as more of an opportunity than a liability by half of the respondents, and as both an opportunity and a risk by 45%. The vast majority rated operational efficiency tools such as e-signatures, remote deposit capture, and integrated loan processing systems as the most important technologies for their banks. Also, liquidity has been a key issue for several years, following a sharp fall in deposits post-pandemic and increased regulatory pressure to maintain liquidity. That said, it's dropped to third place this year in terms of being rated as either an extremely important or very important risk. 78% in 2024 compared to 84% in 2023, but still considerably higher than the 35% it was in 2022. The survey highlights that CFIs are now more reliant on wholesale funding sources such as broker deposits and advances from Federal Home Loan Banks. Use of these funding sources has more than doubled since the end of 2021. And then finally, looking ahead, the survey, according to the survey, community bankers expect to see a worsening of credit quality in terms of individual loans, 65%, commercial real estate loans, 62%, and commercial and industrial loans, or C&I loans, at 54% over the next year. Respondents suggest that office property loans pose the biggest credit quality risk for CRE portfolios. Survey respondents were also asked about their plans to adopt the FedNow service. Over 1/5 already offer the ability to receive FedNow service payments, and 44% plan to offer this in the next 12 months. Only 9% currently offer FedNow service sending capabilities, but approximately 40% plan to offer this in the next 12 months. I will say there, FedNow is a work in progress. It's not fully built out. They're still doing a lot of work on this system. So it's not surprising to me that only 9% are currently offering the FedNow sending capabilities because, like I said, the system is not like a plug and play system. It's not like fully implemented yet. They're still working on various aspects of it. They're still working on the front end and back end interfaces and things like that. So it's going to be a few more years before you really see the FedNow like really up and running and really doing its thing. So like I said, it'll take a few more years down the road to kind of get to that point. So, and then Just over 8 in 10 respondents say that expanding their mobile banking services will be the most promising opportunity for a bank over the next 5 years, followed by implementing a fully integrated loan processing system. And as always, the CSBS survey provides an interesting snapshot of community banks' main challenges and how these have changed compared to previous years. Carried out between April 15th and July 15th of 2024, this was the 11th annual CSBS survey. And then, like I said, and now we'll go checking out the full report. But yeah, I mean, I pretty much agree with everything that was here. I agree with all the external risks. Basically, the overregulation, cost of funds. Again, inflation, still an issue, hasn't really, gone away. Internal risks, cybersecurity, the cost to implement new technologies, the fact that banks have to lean a little bit more on broker deposits and advances from the Federal Home Loan Bank to shore up their liquidity positions. And then looking ahead, obviously credit quality is an issue on the horizon. Banks are highly concerned with credit quality over the next year. And then here's the report itself. Now, I don't want to. I mean, I could spend an hour going through this whole report. It's a very long report. It's 47 pages, but a lot of really, really good information on here. I just want to go down and it kind of has like an introduction here, and it goes into kind of like the key findings, which a lot of stuff that we already talked about. Kind of like funding costs and regulation were nearly tied in this year's ranking for the most important external risk. Community banks continue to rank cybersecurity as the highest internal risk to their banks. Respondents indicated that inflation-created challenges are likely to persist but are manageable. In terms of wholesale funding sources, the biggest shift this year was in broker deposits. Roughly 56% of banks indicated that they are using or plan to use broker deposits or at or near current levels, up 5 percentage points. Roughly 24% of respondents reported currently receiving instant payments, being the FedNow service. A large share of respondents anticipated credit quality to worsen. When asked about certain CRE property types, most respondents indicate that they expected no difference in the credit quality associated with lodging, multifamily, and industrial and warehouse loans. Contrarily, most respondents expected credit quality to be at least somewhat worse across retail and office CRE property types. Nearly 40% of respondents applied a high level of stigma to emergency facilities, while roughly a quarter applied this level of stigma to discount window advances and broker deposits. The lowest levels of stigma were associated with Federal Home Loan Bank advances and public funds. And I have talked about that whole stigma thing there before with discount windows, with broker deposits. For anybody who doesn't understand, broker deposits were persona non grata after the financial crisis. And the reason for that was that you had banks out there that instead of trying to develop a local deposit base, they're instead of trying to get what we would describe in the industry as core deposits. In other words, you have consumers, families, individuals putting their deposits in, putting their direct deposits in at your bank, and using, making payments out of the account, really using your services every month. Small business customers in the area, keeping multiple accounts, a main operating account, a payroll account, a petty cash account, all this kind of stuff. Instead of developing that deposit base, they were simply relying on broker deposits, and literally 90% of their deposits were broker deposits. And then when the financial crisis hit, a lot of those broker deposits got pulled back or went away, left the banks with massive liquidity issues, and that causing a number of them to fail. So basically regulators have kind of, I would say for about a decade, broker deposits were like, no, you can't have any broker deposits, anything like that. No. But I think the broker deposits are fine. I don't think, in other words, if you wanted to put somewhere between, if you wanted to make your deposit mix somewhere between 5% or 10% of your deposits as broker deposits, I think that's fine. I don't think there's anything wrong with that. I think the issue is that if you have a very high loan to deposit ratio, if your loan to deposit ratio is 100% or 105%, and you've got to constantly kind of plug the gap with broker deposits or your lending, that's not the ideal situation to be in terms of managing your balance sheet and stuff like that. And I think that's where regulators can get a little antsy where, you have to, in order to fund the growth, in order to fund new loans, you're constantly going out and bringing in new broker deposits, constantly tapping the Federal Home Bank line. That's not really how you want, that's not the ideal thing to be doing year in and year out. Let's see here. What does it say here? Given these limitations, the conclusion in this year's survey report should be quantified accordingly, because each respondent did not answer every question. Responses are expressed as percentages of respondents to specific questions. Because of rounding, not all percentages will sum to exactly 100. Okay. All right. And then, like I said, a lot of great statistics here. Asset side of surveyed banks, number of branches of surveyed banks, percentage of respondents as a map of the country here, survey participant rate by state, external risks, again, cost of funds, regulation, net interest margin, core deposit growth, cost of technology, economic conditions, competition, loan demand, workforce attraction, speed of technology, climate, cost of funds, banker perspectives, regulation, external risks, again, banker perspective on each of this, the risk of inflation, internal risks, again, cybersecurity, liquidation, additional internal risks, products and services, technology and technology services, like so. And let's see if we can get down here to, should be like a conclusion here at the end. Let's just scroll down here real quick. Kind of gives here acknowledgments to a bunch of different people at the end. Man, comments on yield curve, third-party risk, with many banks considering fintech partnerships and banking as a service. Third-party risk management is a critical component of modern banking. What steps does your institution take before moving forward with a partner? Can you provide a specific example of how fintech partnerships develop? Regulations, artificial intelligence, competition. So some really great information here at the end of this report. Competition, again, yield curve, third party. So this is kind of like interviews with different banks. Lori Maley, president and CEO of Bank of Bird in Hand in Bird in Hand, Pennsylvania. So that's a really funny name. And I should actually do a whole episode on them because it's really fascinating. I think they are the only startup bank in Pennsylvania since 2008. I could be wrong on that, but if there's another one, there's only one more. But Bank of Bird in Hand is a very interesting bank. They cater specifically to the Amish population out in Lancaster County, Pennsylvania. A very interesting thing that they do. They have like no technology, no website, no mobile app. None of that. They have a drive-through. I think they have 2 branches. The drive-throughs are designed for the horse and buggy carriages for the Amish people. So it's real, but they're doing great. I mean, they're doing fantastic. I think they went from like 0 up to like 400 million in assets, and I think in about like 3 or 4 or 5 years, and very profitable. Like just doing. I mean, they've got their niche and they're working it, and it's going great for them. But yeah, I'll have to do an episode on those guys because it's, like I said, really interesting bank, really interesting strategy they got going on there. So anybody that tells you that you can't do a successful startup bank today that's absolutely incorrect. You can. It just depends on what your niche is. What is your niche and what is your strategy? That's what it's all about at the end of the day. If you have a niche that can really work and a strategy that's really effective, you can absolutely start up a bank and be very successful at it. So, okay. And then it says, and then transcripts of interviews based on bankers. And then it goes into like the 5 questions, they asked each banker: artificial intelligence, third-party risk, regulation, competition, yield curve, end notes. And then here's the conclusion here. And I'll just read this one paragraph here, and then I'll wrap this up. So cybersecurity, technology and implementation, and costs and liquidity were all identified as top internal risks this year. Given the focus on competition, the importance of technology implementation remains critical for community banks. Online banking remained a focal point for survey respondents, with nearly all offering remote deposit capture and most providing online bill pay. Nearly 1 in 4 respondents reported that they are currently receiving instant payments via the FedNow service, the real-time payment settlement service introduced in 2023. Many more are planning to add this service in the next 12 months. Conversely, bankers continue to report little interest in offering cryptocurrency services, with the vast majority uninterested in offering such services in the near future. So yes, if you haven't checked out my crypto series or the BND Strategy Room crypto special that I just did the other night, please go on and check those out if you want to learn a little bit more about crypto. So, and crypto in particular, in the banking business in particular. So that's what I got today. Excellent report from the CSBS. I love looking at that annual report. A lot of great information in there every year. And like I said, so I'll wrap up with this. If you like this episode, please make sure to like, share, and subscribe, as it really helps the channel. Please be sure to leave your comments down below, as I love getting back to everybody. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to check out some of the other content on the channel, and I will see everyone again real soon. Thanks a lot.